Bismillahirrahmanirrahim. Assalamu alaikum everyone. My name is Yasir Yamin and I welcome you all in this session. Guys, today we are doing some further practice on ethics questions which are tested in question number 2 of your examination, of your SBR examination, right? So the question that we are doing is relatively a recent past paper from December 2021 and its name is Renshaw, right? So December 2021 and Renshaw. All right. Now, let us just go towards the background first. I always say to my students, first read the background of the question. So it says that Renshaw company develops gaming apps. So it's a modern type company, right? So it develops gaming apps for which customers are encouraged to buy enhancements and add-ons to play more effectively, right? Like any other game. Whenever you play a game, and especially if it's online, right? So the game motivates you to purchase certain credits or coupons, which allows you to buy certain sort of weapons or maybe cars or maybe something like that. It gives you a more pleasing experience, right? The company's current financial year end is 31st of December 20x8. So point to be noted, my lord, 31st December 20x8 is your accounting year end, and that means your accounting year starts on 1st January x8. The following exhibits available below provide information which is relevant to the question. Loans to customers. So there are going to be 3 exhibits, 1, 2 and 3. The first exhibit is going to be about loan to customers. Now this will describe the ethical issues relating to authorizing loans to customers. So the first exhibit is primarily based on the ethical issues that are there while you are authorizing loans to your customers. So your customers would basically be gamers, people of a certain age who like to play games, and you are giving loans to them, and the authorization of loans is subject to some ethical issue. So exhibit number 1 is most likely be predominantly going to be about, it's predominantly going to be about ethics. Yeah. Then exhibit number 2, this is going to be about acquisition of assets. Sets out the accounting for acquisition of intangible assets that does not constitute a business. All right. So accounting for intangible assets, maybe IS 38 comes into play here, intangible assets, right? Then there is payments for the app, describes the accounting for and derecognition of intangible assets. So intangible assets again. Now, before reading the question any further, what I would advise to every student is just go through the requirement briefly. The requirement structure is, there are 3 requirements to the question, A, B and C. It's to total 20 mark question, 2 professional marks in it. There are 3 requirements, 8 marks, 4 marks and 6 marks. So the biggest requirement in this particular question is requirement number A, in which examiner wants you to discuss the ethical and professional dilemmas. Now, a dilemma is a situation whereby, you are confused what should you be doing, right? So an ethical dilemma is a scenario whereby maybe your personal interest is doing A, while professionally you are supposed to do B. Yeah. So if your personal interest is with A and you do B, you will be compromising on your personal interest. But if you are following your personal interest, you will be compromising on your professional interest. So a dilemma is a scenario whereby there are conflicting, there are conflicting objectives. If you fulfill one objective, the other one will be compromised, and if you fulfill another objective, the first one will be compromised. This is a dilemma, right? So examiner is saying, discuss the ethical and professional dilemma for the financial accountant in overseeing the loan made to customers and the appropriate actions to be taken. So you need to discuss the ethical dilemmas that the financial accounting is, witnessing while overseeing the loans made to customers. And what should be the appropriate actions, which are to be taken. And most likely so, if you have read the background clearly, this relates to exhibit number 1 only. Right? So we focus on exhibit number 1 as far as the first 8 mark requirement is concerned. Let's go through the exhibit number 1. Exhibit number 1 is all about loans to customers. The financial accountant of Renshu Company, who is an ACCA member. Remember, if the financial accountant is an ACCA member, then he must abide by ACCA's code of ethics and make all efforts to make sure that the financial statements which are prepared and presented to investors represent true and fair view of the business affairs. You are an ACCA member, you are obliged to follow the ACCA's code of ethics, right? The financial accountant of Renshu Company, an ACCA member, is responsible for overseeing the authorization of small loans up to $500 to customers for use on their gaming app, Jammy Play. So, as far as I understand, you see, Jammy Play is your game, and there is a financial accountant who can allow your customers loans up to $500, which these customers can use to procure things on the game Jammy Play. And maybe if they compete in such type of competitions and play, maybe they can pay off the company this way, right? So you are basically a financial accountant who is responsible to authorize loans to worthy customers. So it's like a credit that you're giving to your customers, right? In order to boost up your revenues or everything. He is paid a commission based on the number of loans granted in a period. Oh my God. Remember, guys, whenever a person is given performance related pay, right, there is always a risk of misuse of power, right? There is always a risk of misuse of power. So you, being a financial accountant, are paid a commission, and you are paid a commission based on the numbers of loans granted. So the more number of loans you provide, the more you are to be given commission. Can I say there is clearly a self-interest for the accountant? I mean, you are responsible to authorize loans. Your personal interest would be to earn more and more commission. But your professional interest would require you to only grant loans where eligible, right? You are an officer who is responsible to grant loans to customers. If you allow loans to those people who are not worthy of paying it back, or they may be deliberately taking money from you and not paying up back, that would be against the business's professional requirement. So, at one place, you want to earn commission. At the other place, your organization wants you to be so objective in providing loans that they don't suffer a loss. And if you provide those subjective loans, you won't be earning a good commission. If you want to earn good commission, you need to do something, hasty, and you need to do something, which is more risky for your organization. So it's a clear dilemma. It's a self-interest. Examiner says the effective interest rate on the loan is approximately 1,076% per annum. Wow. 1,076% per annum. Definitely your customers would be taking this amount of maybe they may be motivated, they may be fascinated with the game so much, they might take up loans in order to buy coupons and enter into competitions and things like that, have some add-ons. But having interest rate of 1,076% per annum, do you really believe your customers will be in a position to pay you back? I mean, there is a clear tendency of your customers defaulting. It seems as if the organization in itself has, there is a questionability on what type of interest rate you are charging to your customers. There is a clear tendency that they will default on their loans. And so definitely they are not borrowing $500 up to $500 for you for a period of one day. They are borrowing like maybe for a month or 2 months or 3 months or 4 months. Still, if they borrow for 3 months, let's say, they would be paying 250% interest. That is so much. 2.5 times of your principal amount and plus the principal amount. That is insane level of money. So maybe you're targeting your customers, you're exploiting your reach, you're exploiting your goodwill and charging too much to your customers. Now, in such a scenario, the accountant, will be facing a higher dilemma. He wants to earn a good commission, and he knows the organization is charging exorbitant amounts of interest from their customers. So maybe he has this opinion, all right, the organization is doing something which is technically immoral. Why can't I do things, why can't I do something which is immoral? He might provide loan to a customer who has definitely no capability of paying it back. But then your accountant might feel, okay, but the interest rates are exorbitantly high. Nobody could pay it back. So, I mean, we both are immoral in that own regards. The financial accountant might be of this opinion. But if he feels, you see, my point is, if he feels that the company is charging exorbitant amount of interest rates, he should resign from his position. But he should not be involved in a wrongdoing, right? It says, however, if the loan is paid back within 1 month, there is no interest charge. So there is a catch to it. No interest rate charged if it's paid within 1 month. Examiner says customers apply for a short-term loan via an online portal which gives them an instant decision as to whether the loan is approved. All right, so there is limited connectivity of the financial accountant with the customer's end decision. But artificial intelligence systems which have been subject to frequent cyber attacks are used in the process. Very good that there is no connection between a human and the customer's decision to provide them loans. But the system is subject to artificial intelligence. It's a financial monetary based system and it has been subject to cyber attacks. That means that the cyber attacker could eventually break into the company system and allow for random loans to random people and cipher off money from the company. Now, you are a financial accountant, you are responsible for this whole process. What should you be doing? You see, long gone are the days whereby accountants were only responsible for bookkeeping. You're not bookkeepers anymore. You must have some sort of commercial acumen if you are to survive in today's technological evoluted world. It's a technological evolution that is happening everywhere. Now, if you feel you just by making debits and credits you can survive, that's untrue. That's not the reality. Now, if you really want to survive, you need to deal with technology. And if you're responsible for a process which allows loans to customers and it's a risk for the company, you need to make sure that you understand the technology that is being used in such a process sufficiently. I mean, you cannot be an IT expert, but sufficiently you should be aware of the risks involved. For example, if there are cyber attacks happening on the system, you should be making sure that anti-cyber cyber security softwares are in place, cyber security mechanisms are in place so that your systems are safe from cyber attacks and the company is not exposed to exorbitantly high amounts of high amounts of risk if loans are granted to random people and the money is ciphered off from the company. I mean, you are a financial person, all right, but you're not a bookkeeper anymore. You need to safeguard your shareholders' interest, right? That should be very clear. Examiner says, currently the laws on customer credit in the jurisdiction, the laws on consumer credit in the jurisdiction only allow such loans where the credit worthiness of the applicant has been checked. So even by law, the credit worthiness of the applicant has to be checked. But then again, there is a risk of cyber attack, and that cyber attack could basically manipulate your AI systems and cipher off money which is not the money of the company. Technically it's the money of your shareholder that could siphon off the money from your company. And you're a financial accountant, you are a person responsible for this whole disbursement process. You cannot just say, okay, I'm not an IT expert, what can I do? I mean, you should be talking to relevant people, understanding what are the risks involved, and guiding appropriate people on the appropriate safeguards that need to be implemented, right? So this is a professional dilemma that you're facing. So the professional dilemma is, you are based on the number of loans provided. Yeah, so your personal interest is on earning higher commission. There is a risk that you might provide loans to some people who are who might default in future. Furthermore, the interest rates are exorbitantly high, so there is a clear risk of default. And the system that your organization uses, for which you are in charge, is prone to cyber attacks. So there is no cyber security in place. And plus, the AI systems you may not be well versed with. So you need to make sure that you understand the systems, you understand the underlying process that is being happening, in the department which you are responsible for. And you should be, you should be asking for appropriate responses from appropriate people, maybe the IT head. But you need to make yourself aware of this thing. Otherwise, you cannot survive, and the organization is relying on you, and still it's at risk. There are two groups of customers, group A and B, who have different social demographics. All right. So basically, your company, what they are doing is, the AI system classifies your customers into two demographic groups, group A and group B. The financial accountant has full knowledge of the AI system. Very nice. And knows that the credit approval system is positively biased in favor of group A. Wow. The system in itself is not objective, it's positively biased. Should you be comfortable with this, with such a scenario? Acha. He defends this practice by saying that it gives group A a chance to improve their financial position. So clearly, group A type of customers belong to a certain demographic and they are not financially well off. He understands he might be in the team when this whole AI system would have been designed. He knows that the system is positively biased towards group A customers who may not be financially well off, and certainly there is a risk of default, but he believes that this is a good approach towards providing loans from the company, because this provides the opportunity to group A type of customers to make their financial being better. He's trying to be a Robin Hood. He's stealing from the company and providing it to people who cannot afford it. But that doesn't make sense. You're not there to do that. You are there to safeguard your shareholders' wealth. I mean, this is clearly not acceptable. He knows this thing, and then he's not saying anything. Group A is known to be have less wealth than Group B and is less likely to be affordable to pay back the loan within a month. You are aware of this? You are aware of this? And then you are not doing anything? Clearly a threat to objectivity. So as far as this part is concerned, examiner wants you to discuss the ethical dilemmas and everything, right? So we'll go through the answer. I've written an answer for you. Again, this is an answer written by me. I try to be as clear as possible. I try to use words that are as simple as possible, so that it helps you in understanding the answer overall, right? Now, how do you approach this answer? Remember, this is a very good question and it's a very subjective question to attempt. It's not merely about accounting implications. Examiner wants you to talk your heart out as far as the accounting, ethical and professional dilemmas are concerned, because not always an accountant would be subject to an ethical scenario which is only about accounting, right? So if you're made responsible for a part of the business and you understand that something wrong is going to happen or can happen, I mean, eventually it will have a financial exposure for the company. So you cannot say, okay, this is not concerned with debits or credits, so I should be ignoring it. No, accountant for today is a commercial person, not a bookkeeper anymore. So you should be able to answer such type of questions, right? How I have written an answer, just understand. The financial accountant is an ACCA member, which means that he must abide by ACCA's code of ethics. Remember, in the first part of the question, it was written that the financial accountant is basically an ACCA member. So, how I approach towards a question, how I write answers is that I go through the exhibit one by one. Once I've read the whole exhibit, I go through line by line and try to answer each and every component of the entire case, so that my answer is eventually complete, right? So I took this from the first line of the question. Yeah, the use of technology has grown over time, with automated functions being performed through complex algorithms, often not understood by many. Remember, accountants should also ensure that financial statements are free from bias, be neutral, and free from any material errors. Therefore, a review of the systems and its related financial implications is necessary. I mean, you cannot relieve your duty of reviewing financial systems that are in place. I mean, whenever you provide a loan to a customer, there is going to be an accounting entry, receivable debit, and bank credit. So the system which is responsible for authorizing loan and the eventual accounting entry that it put into your books, you cannot say I'm not going to review this IT system. I mean, it's ultimately related to the financial numbers that you are corely responsible for. This is part of professional behavior and competence of the accountant. Now, with reference to the case, now we are in the application stage. In this case, financial accountants oversees the authorization of small loans to gaming customers. Remember, authorizing loans would eventually mean a receivable debit and bank credit when the loans are provided. This authorization must be based on a credit check mechanism, so that company does not undertake significant credit risk. Makes sense? Accountant should maintain integrity and be straightforward and honest in his business and professional dealings. However, this is a clear self interest threat, as his own remuneration is based on the number of loans granted. So, the more transactions are authorized, the more remuneration is going to get. It's a clear self interest threat. It is mentioned that the online portal automatically grants an instant decision for approval of the loans. However, the system is exposed to frequent cyber attacks, which could lead to inaccurate assessment, which is a risk for the accountant. The accountant needs to ensure that appropriate control mechanism is in place to secure against cyber attacks and inaccurate credit assessment. Now, this can be a self-review threat if the accountant is involved in the design of the AI system. You see, it was written that the accountant has full knowledge of the AI system. And how would he have had this complete knowledge of the AI system? He may have been responsible for designing the system. And if he's responsible for designing the system, and then we expect him to, identify his own mistakes, this is a self-review threat. It is mentioned that accountant is fully aware of the AI system. Moving forward. Furthermore, while providing loans targeting a particular social segment may not be a completely ethical, but also it has financial implications. It is known, remember, it is known that group A of customers do not meet the credit check criteria as required by law and practice. However, the accountant should maintain integrity in its assessment and do not defend something which is known not to be true. The social defense of the accountant in such a scenario is that he wants to provide a chance to group A customers to improve their financial health. Remember, all of this has been taken from the question itself, right? But he has a clear self interest because he is remunerated based on the number of loans granted. He is playing with social defense, but there is a there is a clear self interest, because he is rewarded based on the number of loans granted, right? So this is important for you to understand. His statement lacks logical defense, as it does not clear how providing loans for games can improve the financial position of group A customers. Moreover, an annual interest rate of 1076% has its own moral questionability. The accountant should establish internal procedures to review. Remember, your examiner wanted you in the requirement, examiner wanted you to mention the appropriate actions that should be taken, right? So you write, the accountant should establish internal procedures to review these ethical and professional dilemmas or seek necessary professional advice on the development of AI systems, cyber attacks, and government regulations on loan authorization. Remember, for an accountant, it's not bad to seek advice from anyone. If you're not clear with anything, seek advice. This is the way you should be working on. In case accountant is under pressure of someone to implement such mechanism, then he should maintain objectivity and not allow undue influence of others to override his professional judgment as an ACC member. So clearly a generic question and you provide a generic answer. I'm very sure that even 50% of such quality of an answer, if you have written, you would have got full marks, right? So 8 easy marks. Even a person who is not well versed with clear accounting, IAS and IFRS, even that person could have attempted such type of a question and gained 8 easy marks, right? So this is not clearly linked to IAS and IFRS, but a clear ethical dilemma. Sometimes these type of questions can come into your exam too. All right, so now look at part B of this question. Part B is for 4 marks only. An examiner says discuss whether the customer databases and domain names. Customer database is the customer information that you have, right? And domain names means, let's say, the website domain that you have, right? So it's like acconline.co. This is a domain. www.acconline.co is a domain name. Just to provide you a certain feedback before we even go and attempt this question, you know na that domain names in itself is a business, right? So there are people and companies who buy domain names, right? And they buy more common and famous domain names and they buy it for a cheap price and they sell it in future at a higher rate, right? I remember I read somewhere that there was a brother and a sister in India who actually bought a domain name. If I'm not wrong, I can be wrong, right? Who bought, they bought a domain name which was related to Geo, I think, GIO, Geo. They promptly acted. They knew that Tata company, maybe, I think I remember the story right. There was Tata company who was actually, launching their own telecom service or something. And when they knew about it, they went on the website and bought that domain name which was related to Tata or Geo or something. And eventually Tata, which is a very big group in this world, not only in India, it's a very big group. When they launched their services, they had to publish their website, and they were searching for a domain name which is relevant to their proprietary name, and those guys had it. So they had to pay a lot of money to those individuals just to get that domain name. Yeah. So for example, you see, my website domain is acconline.co. Yeah. So what if you were to go on website? I mean, there are domain sellers, GoDaddy and something like that. What if you go and buy a domain name which is yasiryamin.co? Maybe one day or the other I will be making my own website, and you have already bought this domain name yasiryamin.co. Now what will happen is, when I decide to finally launch my own website, by then you would have bought this domain name which is with my name. Now I would have come to you and request you to sell me that domain name because it has my name in it. Maybe your name is your own name is Jack, so you have nothing to do with yasiryamin.co. But since you knew me, you bought this domain name, and now I have to come to you and say that please sell me this domain name because it has my name. And you're like, okay, I will charge you $1 million. And definitely my answer is going to be, go with it. I don't care. I'm not going to launch my website. I'm going to launch my website with the name of Jack. Not going to pay you $1 million. But still, it's a business that people do. Nevertheless. So discuss whether the customer database and domain names should be recognized under IS 38 intangible assets. and how the purchase price should have been allocated in accordance with IFRS 3 business combinations. This is a 4 mark small mark requirement. So I don't think there is too much things to discuss. It should be clearly straightforward question. Let's hope for it. Exhibit number 2, acquisition of assets. I mean, it says that Renshu company has purchased a company which comprised a customer database and a number of domain names. All right. So Renshu company has bought another company, and this company seems to only have two things. Customer database. It has a list of customers and domain names, right? So both are intangible assets, right? If you buy a company which provides you access to sole individual assets, you know that according to IFRS 3, this particular acquisition of a company will not be treated as a business combination. Rather, it will be treated as an acquisition of asset, not an acquisition of not a business combination, right? Although it comes within the legal purview of a company legal structure, but this is an acquisition of individual asset because it does not seem to have input processes and outputs. This is an acquisition of intangible asset rather than acquisition of a company. And even examiner specifies that this does not constitute a business. Therefore, Renshu company has to allocate the purchase price to individual identifiable assets in accordance with IFRS 3 business combination. The customer database relates to a contractual arrangement whereby Renshu company receives a commission for referring customers to online gaming websites. So you acquired a database, and your plan is to use this database and sell and use this data to allow other companies to leverage from this data. Yeah, so it is similar to what like Facebook does, right? So Facebook has, or Instagram has, all of our information. Facebook knows about what I like, what I dislike, what I search on weekdays, what I search for on weekends, which pages I have liked, which actors, actresses, what, where are my friends, in which localities are my friends. They know about everything, right? And Facebook leverages this data by providing this database, or by providing access to this, limited access to this database, to other companies who want to market their products to us. So the whole mechanism of Facebook and Instagram and other social media platforms is to leverage customer database and use it for the purpose of providing marketing services. And for this, whenever you run an ad on Facebook or Instagram, Facebook earns a commission out of that, right? So it says the customer database relates to a contractual arrangement whereby Renshu company receives a commission for referring customers to online gaming websites. Renshu company either receives an upfront payment for every customer referred to the gaming website, or receives a share of revenue streams based on the reference customers' further usage. So you earn income out of it, right? The acquired assets also include a number of domain names for websites which have a gaming content. Renshu company had arbitrarily allocated the purchase price for the company to the two intangible assets, domain names and customer base, on a 50-50 basis. So basically, Renshu has done it on a 50-50 basis. Do you think this is correct? No. Sir, how to approach this question in terms of the answer? Let me tell you. Let me tell you by reading the answer with you. Okay. You see, according to IFRS 3, a business combination shall be accounted for under the acquisition method of accounting, whereby acquired assets and liabilities are to be recognized on a fair basis. Furthermore, an identifiability criterion must also be met for intangible assets to be recognized under IS 38. As far as the recognition of intangible assets is concerned, you see, customer data is backed by a contractual agreement that provides the company the right to future economic benefits, so it meets the identifiability criteria and hence should be recognized as an intangible asset. As far as the customer database is concerned, customer database is an intangible asset, right? The acquisition of domain names would also satisfy the separability criterion since they arise out of a contractual relationship. I told you in my opening paragraph that these domain names can be sold in future, so these are intangible assets. One thing is clear. How to value these? The arbitrary allocation of purchase price is not correct. You see, examiner, look at the requirement. Discuss whether this should be recognized under IS 38. The answer is yes. How the purchase price should have been allocated in accordance with IFRS 3. So, arbitrary allocation is not correct. As per IFRS 3, the purchase price should be allocated based on the fair value of identifiable assets and liabilities. So, for example, you bought the company for $1,000, the independent fair value of the customer database, and there would be a fair value because it is backed by a customer agreement. I mean, you can calculate the present value of future cash flows, right? So let's say the customer database has a value of 1000 and domain names have a value of independent fair value of 1500. You can use this 1000 like this. So 2/3 go on to, let's say, customer database, and maybe 1/3 could go on to domain price. The point that we are, what I am trying to say is that according to IFRS 3, the purchase price should be allocated based on the fair value of identifiable assets and liabilities. I mean, a proportionate method should be used. This fair value should represent market perspective rather than the entity's perspective as per IFRS 13. This is a clear, crisp answer of Renshu Company. By now, you would have imagined that even this requirement is a non-traditional requirement. So, very good question to practice, right? Advise Renshu Company on the accounting treatment of the payments for the app in the year ended based on the assumptions that the amount did not meet the recognition criteria for intangible assets, did meet the recognition criteria, and did not meet the recognition criteria. All right, so what I'm trying to say is there is a 6-mark requirement. There have been some payments for an application. Examiner is asking you what you need to advise on the accounting treatment if IS 38 criteria is met, and if what happens if it's not met. Yeah, Renshu Company develops new gaming apps in conjunction with other companies. So often you venture with other companies to create games, right? When acquiring a stake in these projects, Rensho Company makes an upfront payment and agrees a series of further payments based on fulfillment of certain defined objectives in the process, but before and after the app is given final government approval. So normally what happens is you venture up with other companies, you make an upfront payment, right, like $1,000, and then you make a series of other payments as well. Till the time, and some payments are made before you seek final government approval, and some payments are made afterwards, right? So the question is how to classify these payments. Yeah, prior to the current year, the payments made have been accounted for as an acquisition of separate intangible assets, as the price paid reflected its belief that future economic benefits will flow to Renshu Company. The probability recognition under IS 38 was considered to be met. So, in prior years, all of the payments that you had been doing for the development of such games, you have been capitalizing those as intangible assets. However, in the year to 31st December 2008, which is this year, Renshu Company revised its strategic plan and decided that all previously capitalized amounts to date were to be de-recognized and expensed as if research and development costs. Now, there is a confusion. Previously, Renshu thought that future economic benefits will flow. But now, the entity has revised its opinion. However, they cannot simply de-recognize intangible assets unless they are impaired. So the company is saying that previously we thought that the capitalization criteria was met. And now they are saying, no, we should be recognizing all these expenses as research and development costs. Now I have a differing opinion. Is this impairment? Or is this a fault of before, which you have, just clarified now? I mean, the question is, were you wrong in capitalizing these intangible costs before? If that is so, it's a prior period error. Or if you now feel that they should be, expensed out as research and development costs, these should not be expensed out as research and development costs. This should be then expensed out as impairment expense. If there is a change in your assumptions regarding future economic benefits, there should be impairment testing done and impairment charge should be written up. Why are you saying just change the method from this year? You're not allowed to do this. Yeah. Examiner says, this reversal of the current accounting treatment has arisen due to concerns that payment did not meet the criteria for recognition as intangible assets, and also the cost will not be recovered in full. Then this is a clear impairment hint. You should be referring to IS 36 then. Renshu Company considered this action to be a change in accounting estimate and therefore recognized the amounts prospectively by recharging payments to profit or loss. First of all, this is not a change in accounting estimates. This is a clear impairment hint. You should be referring to IS 36 there. Yeah. How do you answer? You see, if it is, the first assumption could be that we made a correct assessment in prior years and we were correct to classify these costs as intangible assets. Let's first look at the first opinion. If we were correct to classify these expenses as investments in intangible assets in prior years, then now it's an impairment. Yeah. So if in prior periods the recognition for intangible assets was correctly met, then intangible assets should only be de-recognized when future economic benefits from use are not expected or they are disposed of. Since Renshu Company is not planning to dispose of these assets, therefore its de-recognition is not appropriate. However, if internal circumstances suggest that there is an impairment indicator, then impairment test should be performed. Renshu Company should compare the carrying value of the intangible assets with its recoverable amount. And if carrying value is higher than recoverable amount, then impairment loss should be recognized rather than a change in accounting estimate. What if we come to the conclusion that we should be de-recognizing all of our previously capitalized intangible assets because we were incorrect to classify them as intangible assets previously? In that case, if the recognition criteria for intangible assets was not met even in prior years, then it has to be assessed that if the criterion was factually not met, then this should be treated as a prior period error. And as per ISA, this should be treated with retrospective restatement by adjusting your opening balances of assets, liabilities, and equity. There should be a difference balance or to be written off in opening retained earnings, right? So this is what should be done as far as the payment for applications are concerned. Again, I would say that this particular examination attempt and this particular question is a very not normal question, and that is why we are practicing on it. But certainly there is overwhelming ethical part to this question, and there is less whelming accounting part to this question, which is a good sign in itself. These type of questions can also come into your examination, so it's good to practice such type of questions. I highly recommend you to read this question by yourself once as well and try to read the answer as well, and maybe you can write your own answer and maybe you can come up with your own points, even those points which I have not mentioned in my answer, and we can clearly discuss that. All right, so I hope you understood this very well. Take care. Allah Hafiz.